Let's take a look at a few home selling opportunities for buyers and sellers when a loan is involved. 1. Bank financing. In today's market, sellers are facing some challenges when trying to sell their home. With fewer buyers and higher interest rates, many homes sit on the market much longer than anticipated, and sellers have to drop the price several times to go under contract. Closing typically occurs 30 to 45 days later, subject to appraisal and financing contingencies. After inspections, though, most buyers ask for additional seller concessions unless they terminate the contract during due diligence, which sadly is much more common these days than ever. When they do make it to the closing table, title is transferred, the lender is protected with a security deed and mortgage, and the buyer becomes responsible for monthly payments, usually for 30 years. In today's market, many sellers are walking away with much less money than they originally planned. 2. Seller financing. In this scenario, the buyer and seller strive to create a win-win. In addition to the price, both parties align on the down payment and the monthly payments made payable to the seller. This is also known as an installment sale. Because the seller is the lender, there are no financing or appraisal contingencies, and closing occurs approximately 15 days later. At closing, the seller receives the buyer's down payment and the title is transferred. Like a bank, the seller, now lender, is protected with a security deed and, in this case, a promissory note prepared by the closing attorney. The buyer becomes responsible for equal monthly payments, usually for 5 years if not beforehand. The last payment, also known as a balloon payment, is one large lump sum for the remaining balance. In the end, the seller earns significantly more for the home than the original asking price because the buyer has made interest payments above and beyond the agreed-upon sales price. 3. Wraparound mortgage. A wrap is when the buyer takes over the seller's mortgage. Again, the buyer and seller strive to create a win-win. In this scenario, they agree to the price. The down payment and the existing mortgage commitment becomes the responsibility of the buyer. As a result, no financing or appraisal contingencies are required. Because the buyer purchases the home through a land trust, the due on sale clause is not an issue per the Germain Act, which is law. At closing, approximately 15 days later, the seller receives the buyer's down payment, the title is transferred, and the buyer becomes responsible for the seller's loan commitment. The seller is protected by a security deed and a wrap promissory note prepared by the closing attorney. The buyer then makes the mortgage payments for the length of time the buyer and seller had agreed to in the contract, say 5 years. Each month when the payment is made, the seller benefits from the principal paydown. Many sellers prefer this scenario because they earn significantly more for the home than the original asking price, as the buyer pays down the debt owed. On or before the 60th month, the buyer settles up. The seller is paid the agreed-upon purchase price in a balloon payment less the down payment the seller received at closing and the mortgage balance due. In today's market, more buyers and sellers are leveraging a variety of financing options, so all parties win. For more information, contact Amy at Purpose Driven Real Estate.